Have you heard about the $300 billion bankruptcy by a housing company in China? And are you wondering how that's going to affect investments in the US? If so, you are in the right place. Welcome back to Purpose-Driven Passive Profits.
Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
Guy above me, his name is Nate Armstrong. He is the CEO and founder. My name is Steve Warner. I am the Chief Investment Officer. And here we teach you guys all about great stewardship and how to become financially independent, how to be a great steward of that money. We believe in practicing what Matthew 25 has to say. And we talk about all things real estate investing. So if you want to know about this developer in China, you might have heard of them, Evergrande. Nate, tell us a little bit. What do you know about them?
Yeah, largest developer in China. For like the last 3 years now, the Chinese government has been somewhat subsidizing what they're doing, and they've been running on fumes. They have overbuilt. Their sales are not keeping up with what they've built, and now they're starting to see the ripple effects. And I think that their crash, it's the Chinese economy, like they're not very strong right now, nor is the United States of America. Let's face it. We'll talk about domestic here as well, but the economy in China and the United States are both very fragile right now. And although what I understand what's happened the last 3 years, the Chinese government basically was trying to kill inflation, just like Jerome Powell in the Federal Reserve here. And so they increase interest rates, but now the developer can't access cash that it needs to keep its little, I don't want to call it a Ponzi scheme, but it kind of is. They've been taking deposits from prospective buyers, and they've been taking loans out, and they keep building and building and building, and there's nobody buying the product on the back end. So now it's all going to collapse. It's going to burst.
Yeah. Well, here, I'm just going to read you. This is straight from CNN. The story of Evergrande's downfall began in 2021 and 2022 when the central government in China moved to curb excessive borrowing to slow down the rise in home prices and stunt inflation. This cut off major source of funding for property developers. And then exactly what you said, they had taken deposits. They'd taken massive amounts of deposits to build, and they had spent that to get even more people coming to them. But now they don't have the money to build and they can't borrow. They're on the wrong side of the coin. They defaulted and they filed bankruptcy in the US. They're probably going to have to file worldwide bankruptcy. Man, we're seeing this in the US too. I mean, the same thing is happening. If you're looking right now to invest money, good for you. This is the best time to invest, but I don't think you want to be in a development project. Nate, why would you avoid development right now?
Yeah, precisely because of what's happening to what we're seeing with Evergrande and what we're seeing with some of our domestic builders too. When economies get fragile, banks are starting to implode, we'll just call it that. What happens is lending gets super restricted. Interest rates go super high. And then the lenders, they become very leery of every project, even projects that have been approved. If there's still money on hand at the bank that they're supposed to be handing out in phases as the project is completed, those banks can oftentimes renegotiate that, and they'll hold it for dear life rather than handing that money out. And so a lot of times when people get into a development project, they think that they've got like financing on the backside if they just get to a certain phase, or they think that they have draws from a bank if they get to a certain phase. But what we found during the last economic meltdown, 2008, 2009, 2010, is that a lot of those banks, when they went back to get more money from them, the banks just said, no, sorry, we don't have it. And so that's what can happen on a development project. Demand starts dropping, and then the banks get tighter, and you find yourself in a rough spot, essentially.
Well, I mean, we saw this last time, like 2009, 2010. if you guys remember, there was a huge development project in Las Vegas going on. It was the Aria and the Cosmopolitan and that whole area. It's called City Center. They were in the middle of it, and they literally halted construction for like 2.5 years. And then China actually came in and bought the project for pennies, finished it out. They didn't finish it as nice as it was supposed to be originally. And then they ended up selling it and making money. I think they still hold the Cosmo. I might be wrong, but I remember seeing that because I was in Vegas a couple times during that, and it was all frozen because exactly what you said. The banks were like, sorry, we're not lending out any money. There's no draw. Vegas, especially, like everybody started leaving Vegas. That whole time was such a rough time. And we're starting to see that again. So where should people look at investing their money right now? Like we've said that now is the best time because there are so many deals. We've been talking like over the last month, 6 weeks, we've seen a huge influx of multifamily. Where should people be investing, and what kind of properties deals should they be looking at?
Yeah, rented, super safe, super stable, bread and butter kind of rentals. So I would categorize that as multifamily real estate, not offices, not storefronts, not even industrial right now. Instead, go with multifamily residential real estate in working class areas. That's going to be the safest. It was the safest through the last downturn. It's the most resilient during a recession. And even if the economy gets really rough out there and these banks do what we're expecting them to do, if you're in a good multifamily property with working class tenants, you're usually in a good spot because those tenants, they find work. They keep paying. And oftentimes, because a lot of the white collar jobs, they tend to go away, middle management and whatnot, they get downsized to an apartment building. And so rents often go up during the middle of a recession.
Yeah, if you guys do the research, you can see that rents have virtually never gone down during a recession or an economic contraction. Rents almost always across the board go up. They never go down. At worst, they will go across. You want to be looking at like those solid, we call them C-class properties. A is like ultra luxury. B is upper class, like fancy, where you're going to pay more to have like a lot of amenities. And then C is like your solid working class apartment that 90% of America can afford without a problem, has good, safe, like it's a good place to live, but it's nothing over the top, right? D is kind of your like bad area, bad condition. And then F is like war zone or place that is virtually condemned, like a flop house. You're going to want to look at that solid C-class properties. The other thing that I would throw out there is you want to make sure that it is in a landlord friendly state. Can we just touch on that one really quick? I mean, we just saw during COVID, right? People that were in California, there are still people in California that are not paying rent.
Yeah, we saw it. We walked a $12 million property in good old Kentucky, which is really landlord favorable. But I got to see the last 3 years of income and expenses from the owner, and I noticed that he took some of that COVID rental relief money from the government a few years ago during COVID. And when I was reading into it, like there were some tenants that, although he got some relief for like 6 months, when the money ran out and the tenant could no longer pay, he wasn't able to evict because he took the money. So there were strings attached. And so you got to watch for that. Like you don't want to be in a state where there's like terrible restrictions on what you can and can't do with your property. Thankfully, Kentucky, if you don't touch government money, Kentucky's a very good state, landlord friendly. You just follow the rules, and if someone's not paying the rent or not playing by the rules, you can have them out of the property in a couple of weeks. Other states like Ohio, Midwestern states, Southeastern Sunbelt states, those are typically more landlord friendly, and they allow landlords to operate the property like a true business. When you start to get into the Californias, the New Yorks, then it gets really dicey. Like you might even have, I just read an article. Did you see the one on squatters' rights where the gentleman in California, he was about to take his mom's property out of probate after his mom died and squatters moved in?
No.
That might be a fun one to actually break down for people, but literally like he had to go to war with these squatters to get him out of the property. But that kind of stuff happens when there's crazy laws. when there's crazy laws that restrict what a landlord can and can't do, California and New York are the strongest in the country, then just stay out. Stay out of those, stay in places where the business is protected.
Okay, maybe we will go into that in one of our future episodes. But Nate, tell us about our latest property, which is, believe it or not, in a very landlord-friendly state of Kentucky.
Yeah. So we got a 49 unit building under contract. Interestingly, we've been working on this one for a year, and the city of Lexington, Kentucky, is the owner of it right now. They tried to get into the landlording game to provide affordable housing to Lexington because it's had a boom for the last decade or so. And what they figured out is that they're not very good landlords. And so they've finally, after working on them for a year, totally off-market deal, they've come to us and they said that they would accept our offer. And we negotiated with them to seller finance it to us. So it takes a little bit of cash, small amount, $1.1 million, and then the rest comes seller finance to us. And we've already raised $1 million of the 1.1. So there's only one spot left, theoretically, depending on the dollar amount. But if someone's interested in that, then just reach out to our office and we'll see if that one's still available.
Awesome. So you can go to homeinvest.com to learn about our deals. You can click there. You'll be able to jump on a call with myself or Nate or Sue. We're the three that would be talking to you. You can answer any questions that you have. One of the most important questions that you want to ask, though, whether you're joining us in one of our investments or whether you're joining somewhere else, be a good steward. Ask them, is it in a landlord-friendly state? What class building is this? Because you want to protect your money. You want to make sure that it grows. Like there's a balance to the risk. And we have found like those solid C-class properties, they're always going to be rented. They're always going to go up in value because rents actually go up, which is what makes the building go up in value, which always makes your investment go up. With that being said, we will see you next time. Make sure you're a good steward of your money, and we'll see you here on Purpose-Driven Passive Profits soon. Thanks so much for listening to our show today. Here's Nate with our latest offering.
Hey, accredited investors. I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
We'll see you soon here on Purpose Driven Passive Profits.